All right, let's just dive right in, shall we? Because wow, 2026 has been an absolutely wild ride for dividend investors so far. I mean, we're seeing this massive, almost unprecedented divergence in the market right now. On one side, we've got SCHD, the classic defensive darling that's finally having its moment in the sun after kind of playing second fiddle for a few years. And then, in the other corner, we have FDVV. This is a high dividend ETF, but it takes a totally different approach by tilting heavily toward mega cap tech giants. So in today's explainer, we're going to break down the hard data to see exactly how these two heavyweight contenders stack up. Because look, it really all boils down to one core question. Whether you've got $500, 5,000, or a $50,000 portfolio ready to deploy, these confusing market conditions are making capital allocation super tricky. You're probably sitting there wondering, where exactly should my money go right now to weather this economic storm but still actually capture some upside? Well, that's exactly what we're going to figure out together. So here's our roadmap for the explainer today. First, we'll look at the 2026 market rotation. Second, we'll do a head-to-head data comparison. Third, we'll uncover some hidden risks to watch out for. And finally, which should you choose? Kicking things off with part one, the 2026 market rotation. Before we throw these two ETFs in the ring together, we got to take a step back, right? We need to look at the big macroeconomic picture to understand exactly why they're behaving so radically differently this year. Think back to the better part of 2023 through 2025. That entire era was basically defined by the Magnificent Seven. Companies like Nvidia, Apple, and Microsoft were just absolutely crushing everything else. If you weren't heavy in tech, you were pretty much left in the dust. But today, 2026, the script has totally flipped. And why is that? Well, investors are getting jittery. We're dealing with this incredibly sticky inflation. The job market is actually starting to show some real cracks, and geopolitical tensions are running high. And you know, when inflation is sticky, interest rates stay higher for longer. Suddenly, the distant future profits of those growth companies, they look a lot less attractive. So money is flooding directly into companies that are making cold, hard cash right now. We're literally witnessing a massive rotation out of expensive growth stacks and straight into value and defensive names. And this exact rotation is why our two ETFs are on completely opposite trajectories right now. Look at SCHD. Its portfolio is basically packed to the brim with safety. We're talking healthcare, consumer staples, financials, companies with consistent cash flow, rock-solid balance sheets, and long, long histories of paying out reliable dividends. It's exactly the kind of stuff people flock to when they're scared. Now look at FDVV. It allocates a whopping 31% of its assets straight into the tech sector. It was built to capture all that massive AI and innovation upside. And hey, during a tech boom, that strategy is absolutely incredible. But during a broad market shift to safety, it means investors are aggressively fleeing to the cash-flowing staples you find in SCHD, and they are severely punishing FDVV for leaning so hard on tech. So how is this actually playing out in real time? Well, year-to-date, SCHD's defensive posture is absolutely crushing it. It's up nearly 27% for the year. Meanwhile, FDVV is sitting at around 12%. Now, let's be totally fair here. 12% is still a highly respectable return by pretty much any historical measure. Most folks would be absolutely thrilled with that in a normal year, but in this specific environment, it's lagging way, way behind SCHD's incredible 27% run. That 15% gap is a massive amount of real money left on the table if you happen to bet on the wrong horse this year. So the big takeaway here is that your choice of ETF relies heavily on where you think the broader market psychology is heading next. Okay. Let's move right along to part two, head-to-head, the data. Enough about market vibes, right? Let's shift gears and look directly at the hard metrics that really define these funds. Let's run through the numbers. First up, yield. SCHD is yielding 3.3%, while FDVV sits at 2.8%. To put that into perspective, if you're trying to live off your dividends, for every $10,000 you invest, SCHD is going to pay you roughly $50 more per year in passive income. Next up is the expense ratio. And guys, this is absolutely crucial. SCHD is incredibly cheap at just 0.06% compared to FDVV's 0.15%. Now, I know a fraction of a percent sounds completely tiny today, but over a 20 or 30-year investing horizon, that cost difference compounds massively. We're talking thousands, maybe even tens of thousands of dollars staying in your pocket just by minimizing those fees. Finally, we've got beta, which is just a fancy way of measuring volatility compared to the overall market. SCHD comes in at 0.67. That means it's roughly 33% less volatile or less bouncy than the broader market. FDV is sitting at 0.86, which means it swings a lot closer to the market standard. So across yield, cost, and volatility, STHD takes a clean sweep. But hold on a second. When we zoom out to a 5-year timeline, the story changes completely. Check this out. If you had put $1,000 into SCHD 5 years ago, you'd be looking at about $1,520 today. Not bad, right? But that exact same $1,000 invested in FDVV, it would be worth $1,887. Boom. That is a massive gap, and it's a huge aha moment because it shows us exactly why FDVV holds that heavy 31% tech exposure. Even with brutal short-term dips, tech companies scale and grow their revenues at rates that, frankly, consumer staples just can't match. When you look at that long-term, multi-year horizon, FDVV's tech strategy has historically dominated overall total return. It's honestly a classic tale. Think of SCHD as the tortoise. It's laser-focused on income, absolute safety, and this slow and steady approach that really just lets you sleep like a baby at night, no matter what the crazy news headlines are screaming. FDVV, on the other hand, is the hare. It is built for explosive growth and aggressive total return, even if right now in 2026, the hare is kind of pulled over to the side of the road to take a quick breather. Which brings us nicely to part 3. Hidden risks to watch. Look, we need to take a completely objective look at the vulnerabilities here so you aren't blindsided by unexpected shifts. And before we drill down into the specific funds, we really have to acknowledge the overarching market anxiety that's hanging over everything right now. We are in a period of really intense, elevated uncertainty. The Fed is walking a super dangerous tightrope, desperately trying to fight off inflation without accidentally plunging the global economy into a recession. On top of that, corporate earnings growth is slowing down everywhere, and market valuations are still historically high. This tightrope walk profoundly impacts investor psychology. You know how it is. When the market gets jittery, we get emotional. We either panic search for absolute safety, or we take wild risks trying to reach for some unsustainable yield. And these macro realities, they threaten both the tortoise and the hare. So let's directly contrast their specific opposing risks. For SCHD, your biggest threat is a resurgent tech rally. If the AI hype train leaves the station again in a few months, SCHD is going to lag significantly behind the broader market, exactly like it did back in 2023. Also, if the 10-year Treasury yield pushes above 4.75%, suddenly SCHD's 3.3% dividend yield looks way less exciting compared to perfectly risk-free government bonds. But on the flip side, what if the economy actually does slow down into a true recession? Well, FDVV's highly valued tech companies are going to get hit the absolute hardest. Investors dump high multiple stocks immediately in a panic. Plus, FDVV has a lower baseline yield, so if you're actually relying on that monthly or quarterly income to physically pay your bills, you are absolutely going to feel the pinch, all while dealing with some really bumpy day-to-day volatility. All right, that leads us right into our final section. Which should you choose? Let's bring all this high-level macro theory right back down to your personal wallet. You should choose SCHD if you are laser-focused on reliable, current income, if you're actively worried about a recession hitting in the next 12 months, and if you really prioritize a value-oriented, sleep-at-night portfolio. You want predictability above all else. Conversely, you should go with FDVV if your time horizon is, say, 5 to 10 years out, if you are fundamentally bullish on the unstoppable, long-term dominance of mega-cap tech, and if you're completely fine stomaching some serious market volatility along the way. Honestly, it's entirely about matching your own personality and risk tolerance to the underlying strategy of the fund. But you know what? Here is a strategic compromise you might not have even considered. It doesn't actually have to be an either-or decision. A lot of savvy investors use the tortoise as their rock-solid core holding and the hare as a growth-focused satellite position. So picture a portfolio that's 70% SCHD and 30% FDVV. That setup can effectively act as a shock absorber for your wealth, basically giving you the best of both worlds. You lock in a high stable yield and much lower volatility with your core 70%, so your foundation is totally safe. But you still keep that 30% exposure to massive tech upside, so you aren't completely left in the dust during the next bull run. At the end of the day, figuring out what kind of investor you truly are based on the data we've explored today is literally the most critical step you can take. Are you prioritizing defense, safety, and immediate income? Or are you chasing long-term total return and aggressive tech growth? Take a hard look at your own strategy, weigh the hidden risks we just talked about, and ask yourself, are you team SCHD or are you team FDVV? Seriously, go look at your portfolio right now and ask yourself, is your money actually matched to your mindset?